A lot of former Wall Street darlings are acting like that Johnny Cash song where they're going down, down, down to that burning ring of fire, and it burns, burns, burns. And looking at Shopify, it has been going down, and it does burn. And I'm saying to myself, man, and I'm sure a lot of investors similarly are saying, holy smokes, how much further down can this go? What's the upside downside from here, and why has it been going down? We're going to talk about all these aspects and more. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing. This is a channel where we occasionally throw in a little Johnny Cash. Let me know if there should be more of that. But more seriously, this is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and I do own stock in Shopify. SHOP is the ticker, just a wee bit. So Shopify has had a monster run the last 2 years. They're crushing it. Revenue nearly tripled. The amount of business on their platform, the GMV, more than doubled. And the number of merchants on their platform nearly doubled as well. And you can see revenue from 1.6 billion to 4.6 billion. Consistent, incredible growth throughout the whole pandemic. And before then, they were growing really fast as well. Most recent quarter growing over 40%. This business is crushing it. And management, in my opinion, is doing the right thing, making the right strategic investments. Most recently, they've been focusing, leaning in on this ubiquitous approach to social commerce. And they've launched really impressive partnerships with Spotify and TikTok to directly enable creators. And this has followed their pattern of already saying, hey, we are going to help merchants meet them where their customers are. And so here it is. They are directly enabling creators like Remy Wolf. I personally haven't listened to any of her music. If you need to hear me do a rendition of some of her music, let me know. I'm not familiar with any of her songs. But saying, hey, Remy, you probably have some tchotchkes you want to sell. We can have the Remy Wolf channel. We are going to power it up. So here it is, the Remy Wolf tie-dye bucket hat, $30. I'm not personally in the market for tie-dye bucket hats, but maybe the tie-dye Unrivaled Investing shirt. I don't know if tie-dye is really on brand. Not quite sure. So they've also been leaning into their global initiatives. So once again, this is part of the let's meet customers where they are approach, recognizing it's not all happening online. It also is happening offline. A lot of business is still happening offline. You need to have an omni-channel approach. You need to enable the merchants to do business wherever their customers are. So that includes launching point of sale tools. And this includes, expanding, let's say, into Germany, saying, hey, we're going to help you with the hardware side as well as the software side that we sort of made our name for. So if management is executing, they're kicking butt and taking names, delivering strong results, why is Shopify stock nearly all the way back to where it was at the start of the pandemic? The answer here, this is a beauty here. Shopify's fundamentals nearly 3x, as I already said. Their valuation fell by about 60% from around 43 times sales, start of the pandemic, to around 18 times sales. This is such a beautiful example. This is such a beautiful example of why valuation matters. I love this example because here it is. And this is so important. This is the whole crux of this channel. You need to understand these 3 points if you're going to be looking at investing. 3 things drive your returns: dividends, fundamentals, and valuation. You got to consider all 3 when you're looking at a company. If a company doesn't pay dividends, perfect. That's fine. Then that's one of the components that you can ignore. But the other 2 you do need to know about. And so here it is. If you have a company that increases their fundamentals by nearly 3x, like they've done, but you have their valuation potentially fall by 60%, your stock goes nowhere, goes close to nowhere. That's just the math. And that's the reason why I think this example is just beautiful. Folks need to recognize you need to pencil out what you think the valuation can do over time. And recognize if the valuation all of a sudden starts getting pumped up because people are really pumped up about it, say, wait a second, well, what's the valuation do when growth normalizes? And that's exactly what we're going through right now. And that's something investors need to be mindful of. You're looking at a period where right now growth expectations are coming down because people are saying, okay, people are returning back to normal. So yeah, they aren't going to be growing at the same rate that they've been historically. That's effectively what it's saying. And you see that they've historically traded at quite a wide range of valuations. So why is the stock declining? So it's not only this change in expectation, but also management is guiding to it. So management is guiding to slower growth in 2022. They didn't precisely call out a figure, but they're saying it's slower than 2021. And keep in mind, in 2021, they grew by 57%. So is that really that bad to say, hey, we're going to be going slower? They expect, there's a little nuance here too, where they expect their lower margin merchant solutions business, and that's primarily tied to payment transactions, to grow at more than double the rate that their higher margin subscription solutions business grows at. So merchant solutions growing much faster than subscription solutions, and merchant is lower margin versus subscription solutions, which is higher margin subscription solutions tied to software subscriptions. So this does imply that their gross margins could decline in 2022. So that does also make investors say, hey, does that impact the valuation that you want to assign to this business if margins are potentially going down in the near term? Okay, so where does Shopify go from here? How do we think about the valuation now that it has gone down about 60%? First, a quick plug, where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies for both good and bad times, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. If you enjoy videos like this, please make a point of hitting that thumbs up, hit that subscribe button. Once again, go to unrivaledinvesting.com, click join the journey. So while Shopify stock is down significantly in just a few months, the reality is that its valuation is still more than 100% above where it previously bottomed. Around 8 times sales between, around 2016 versus around 18 times sales currently. So how much further can it go down? A lot depends. And let me share a little bit of thoughts on, the give and take here. If it previously traded at 8 times sales, keep in mind the company was much smaller then. You have much greater growth potential the smaller you are. It's easier to grow the smaller you are. It's easier to double your business the smaller you are. So arguably, you should have a higher multiple when you have higher growth in front of you. So one could even argue, and I'm not saying this is going to happen, but one could argue that a low multiple should actually go lower than what their previous bottom was, which was around 8 times sales. Now, there's a lot of ways that can happen. The stock could just go nowhere and they can continue growing at a good clip. So that's one possible. So it sort of just treads water. That's one possibility. Another possibility is it just doesn't go there. Part of that dynamic was it was a post-IPO, and sometimes you have sort of a market where, it really hasn't found its true investor base yet, and it just hits sort of an artificial low. So that's possible as well. You might say, well, things were cheap in 2016. I'd argue they weren't really super duper cheap. It was arguably reasonably valued. It went to a period of overvalued. So now it's just a question of I wonder where it ultimately shakes up. A lot depends on the sentiment for looking at something like this, because this business, Shopify, along with a lot of former Wall Street darlings, has not yet fully proved what their long-term margins look like. They're currently around 50% gross margins, but their profit margins are much lower. And so investors need to see, hey, can you actually do, let's say, 20 to 30% profit margins over time? They're nowhere near that now. And so that does create more volatility, more uncertainty over what Shopify looks like in the future. So I say a lot depends on sentiment and their execution. So looking at Shopify now that the stock's around $650 a share, around $83 billion valuation. So while Shopify is down significantly in just the last few months, given that its valuation is still pretty full, there's a very reasonable chance that the stock could tread water in the years ahead, even if they continue to grow at very high rates and prove out their margin structure. They could also double. That's sort of the range that I'm penciling out. Of course, this is just a hypothetical framework, and the stock price can go a lot higher and lower depending on execution and sentiment. The lesson, in my opinion, of the last 2 years is that every investor should strongly consider what can drive their returns. Once again, 3 buckets: dividends, fundamentals, or cash to the shareholders, or capital to the shareholders, fundamentals, and valuation, because you can have spin-offs and things like that, distributions, fundamentals, and valuation. And you can have a business double, but if their valuation falls in half, your return will be 0. You can have a business nearly triple, but if the valuation falls by around 60%, your return will once again be close to zero. And so this is the tricky part with looking at Shopify. I'm currently penciling out, let's say 35 to 45% growth in 2022. Let's say, looking out over 5 years, closer to 30 to 40% annualized growth in the years ahead. Maybe that's too low. Maybe that's too high. We'll see. I'm assuming they get to profit margins in the mid-20s range, let's say around 23 to 28%, ballpark figure, and that in 5 years from now, the end multiple is around 25 to 35 times. That's earnings multiple, 25 to 35 times 5 years from now. And that effectively gets to tread water to maybe more than 100% upside. So that's how I'm currently thinking about it. I'd definitely love to hear your thoughts if you have a strong view on whether or not you think they can perform significantly better or worse. I'm going to continue this conversation, maybe a little Johnny Cash as well, on our exclusive Discord server to further discuss what the unrivaled investing community thinks is the right price to scale up from here. What's the right price to maybe double down or make this a really large position? And that's the question. Or maybe some people are like, man, this is as big as it gets right now, and I'm ready to watch them execute. For the mega Shopify bulls, I'd definitely love to hear the case for why you don't think the valuation won't, let's say, reset to that low that you saw back in 2016. Maybe that low was just artificially low. Or if you see a mega bull case where you're like, yeah, Daniel, that 40% growth, that's not enough. They're going to be closer to 50% over the next 5 years. I'd love to hear that case. So I'd love to further understand. Feel free to leave a comment below. And if this video on singing has been helpful for you, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.